Hello and welcome to Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Tuesday, 2nd December. Coming up on the show, Apple suddenly replaces its AI chief. Short seller Michael Burry says Tesla is, quote, ridiculously overvalued. Costco sues the Trump administration. It wants a tariff refund. And I've got details of the fallout from Bitcoin's worst day since March. So grab your coffee and let's own the morning. Well, the first thing you need to know is all about crypto. Yesterday, Bitcoin had its worst day since March. Monday's dip came on the back of a sharp sell-off in October, and the fallout has been pretty dramatic, especially for one company, Strategy. The Bitcoin champion has seen its shares fall by around 60% since its summer high and has warned that it could incur a $5.5 billion loss if the price of Bitcoin doesn't rebound this year. Its most popular ETFs, which track Strategy's share price, have fallen over 80% this year. Now, it's created a $1.4 billion reserve to fund dividend and interest payments. All right, the next thing you need to know is that Warner Brothers Discovery has received a second round of bids. They include one from Netflix, which is mostly cash. Now, according to Reuters, this auction for Warner Brothers could conclude in the coming days or weeks. Last week, bidders were asked to submit improved offers, and the likes of Paramount, SkyDance and Comcast have also said to be interested. And Reuters believes that Paramount's mostly cash offer of around $60 billion, well, it's already been rejected. Now, the last thing you need to know is that Apple has replaced its AI chief. Amar Subramanya takes over from John Giannandrea. Apple has been a bit of a laggard in the AI race, losing ground to the likes of Samsung, and earlier this year said that AI improvements to Siri would be delayed until next year. There have also been reports that Apple CEO Tim Cook had been losing confidence in his now former AI head. Recently, Subramanya held a similar role at Microsoft. Now, there's still plenty of other stories that are brewing. Well, here's Ali Kanal with what to watch.
Time now for What to Watch Tuesday, December 2nd. Starting off on the earnings front, more retail earnings coming out on Tuesday, along with some names in the tech space. CrowdStrike announcing results for the third quarter after the market close. Analysts expecting CrowdStrike to grow its subscription revenue in Q3 as it launches more products, especially in areas like identity security and AI-powered protection. But the company may feel pressure because existing customers aren't adding seats as quickly, which could weigh on retention rates. Shifting gears to autos, U.S. auto sales data is coming out on Tuesday. Economists forecasting that number to come in at 15.43 million for November. It's a small but positive uptick in demand for new vehicles compared to the prior month, suggesting consumers are still buying cars at a steady pace. And finally, taking a look at the Federal Reserve. Fed official Michelle Bowman is testifying before the U.S. House Financial Services Committee. This coming after a speech from Fed Chair Jerome Powell on Monday. Wall Street will listen closely to all the new commentary for any clues about monetary policy ahead of the Fed's crucial December FOMC meeting.
Okay, now the investor who shot to fame for calling the housing crash before 2008 has now had his say on Tesla, Michael Burry. And to put it bluntly, he isn't a fan. And after shorting AI stocks, he's making a case for a Tesla short trade. Our senior autos reporter, Paramount Subramanya, has more.
In a post about the tragic algebra of stock compensation, guess who came up, right? Tesla, right? So he said, quote, Tesla's market cap is ridiculously overvalued today and has been for a long time. And he said that Musk's pay package will continue to further dilute the stock, right? And in addition, he said that, as an aside, the Elon cult was all in on electric cars until competition showed up, then all in on autonomous driving until competition showed up, and now is all in on robots until competition showed up. So he's also attacking just the bull case of Tesla. And we've seen the last 2 weeks, some prominent analysts have come out very bullish on the AI, the autonomous, and even the Optimus robot stuff. So very pouring cold water on that. He was also in the past been bearish on Tesla too. So this is nothing new. And we saw Jim Chanos too, also in the past, was bearish on Tesla. But they're also piling in on some big high-flying AI stocks too.
And to that point, Burry taking out short positions on both Nvidia, Palantir. So you think he could be speaking to kind of this idea that tech is overvalued more broadly across the space?
Yeah, and I think the names connected to the AI space in particular, talking about circular vendor funding, CapEx build out. He's all concerned about these things that we've heard a lot of people talk about. With regards to Tesla, it's a car company, right? So it has a money-making
Unless
component.
you ask Jan Ives, he says it's offensive to call it a car company.
Yeah, right. I mean, in that respect, yeah, when it comes to like sub 10 PE ratio, right? But I think it's more about, like you said, it's a tech skepticism, CapEx skepticism, that sort of thing. I can't say the word skepticism, by the way, but I'll try.
I know, say it 3 times fast. But when we're talking about Tesla, it's not just a valuation debate. And we got some new headlines that they're starting to lose share in several key European markets while competitors just continue to gain. And we know that's been the story in China. But do you think this is more of a demand problem, a competition problem? And where does Tesla really go from here?
I think it's a mix. I think it's equally a mix of competition, but also demand. We're talking about falling sales in November in France, Sweden, Denmark, and the Netherlands. This follows a massive tumble in October where the entire European region, with their report numbers about a month later, saw a 50% slide in sales, right? So it can't just be just the competition alone or demand alone. The Musk factor, of course, his sort of dwindling reputation there, his perception of the brand is falling. So that's a big mix there. But like you said, if they can solve FSD and AI and autonomous and those technologies, that's a big boost for them, right? People might otherwise say, you know what, I'm going to give them a shot because of the fact I can drive to work, and I can sit here in the car driving to work, right? So that's the bet, and the bulls hope that compensates or overcompensates for competition, and also the Musk factor.
Okay, we're heading for a short break now, but when we return, we'll have some tips on how to get rid of stocks from your portfolio that really aren't up to much. Okay, welcome back. And now it's time to hear from my colleague Jared Blickery, who has some advice on what to do with those stocks that aren't quite performing how you want them to.
Breaking up with stocks is hard to do, especially around the holidays. Do you have any stocks in your portfolio you wouldn't necessarily introduce to your family over a holiday dinner? On today's Stocks in Translation, we are tackling exactly what to do with that stock that you used to love, but now just kind of drags you and your portfolio down. And as year-end approaches, we're going to tell you why a breakup right now might actually help your 2025 tax bill. Let's start with some of the basics. With what's called tax loss selling, you can sell your losing investments now so that the loss shows up on your tax return. Those losses can offset capital gains and in some cases even trim a little bit off your taxable income. There are important rules around all this, especially the wash sale rule, which we'll hit in a minute. But the key is you're not just torching cash here, you're trying to upgrade your portfolio and your position a little bit better heading into the new year. Here's an example. Let's roll the chart of United Health, ticker UNH. This has been the biggest dog of the Dow this year. The stock is down roughly 35% in 2025 and about 5% this quarter. Meanwhile, the Dow itself is up over 10%. United's loss is pretty big for what has traditionally been a defensive, steady earner. And we're not here to pick on any particular stock, just to point out that if you happen to own a stock that you've lost a bit of money on, it's ripe for reassessment. So how do you decide if it's time to walk away? First question you should ask yourself, is the thesis broken? Recall why you bought the stock in the first place. And ideally, you wrote that down somewhere for times just like this. Next, how big is that loss compared with a potential tax benefit? That's pretty straightforward math. Also, is there a clear, fresh reason to keep holding the stock today? Would you buy it right now if you didn't already own it? And finally, the clock matters for tax purposes. December 31st is your real breakup deadline. And if you're leaning towards selling, Uncle Sam has one big ground rule: no wash sales. So let's tackle exactly what that is. A wash sale is selling at a loss, and then rebuying the same or nearly identical stock or security within 30 days, which can erase the potential tax deduction. So if you dump your loser today and then text your X stock back into your portfolio next week, the IRS basically says, nice try, no tax break for you. No rebounding with your X is the discipline. So how do you move on without breaking the rules while setting yourself up for a better future? Here's how to rebound and play the field wisely. Instead of running straight back to the same name, if you've got a type, you can look for similar but not identical ideas. Maybe a broader sector ETF or a different stock with stronger fundamentals in the same space. And if your typical stock pick is a high beta, to the moon party stock, maybe go a little bit more conservative to balance some of your other stock relationships. Use that 30-day window to rethink your goals and your risk tolerance, not just stare at what your old stock is doing on the apps. And watch out for FOMO on those hot year-to-date winners. The stocks that already ran up hard might not be the best rebound partners. And remember, it's okay to ease back in. You don't have to chase every little bounce just because you got some cash. So here's your stock breakup checklist. Take a beat and think about which losing investments still honestly fit your plan. Being truthful rather than just hopeful will get you farther in the investment game. Next, how big are the profits you've already booked so far this year? They're called realized gains. The bigger the locked-in gains, the more use you might have for the offsets that get you from that selling of losers. Then watch out for any potential wash sale landmines in your recent trades. And if you do sell, think about how you can make that cash work for you. Maybe it's another stock, maybe it's just a money market fund earning 3+%. Sometimes we stick in a relationship over the holidays just to be nice, but there's no reason to be nice to a stock. Consider freeing yourself of the emotional baggage of a bunch of red in your portfolio, and you might step into the new year feeling a little bit lighter. And be sure to tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Okay, we're heading for another break now, but we'll be back very shortly to reveal our trending stocks, including one meme stock, which will be back at the forefront of retail investors' minds. Stick around to find out more. Time now to look at stocks trending this morning, and we've got fascinating stories across tech, retail, and of course, AI. Well, let's start with Samsung. The South Korean tech giant has been rising as a chip maker, but it still wants to remain the leader in phones, and it's making a statement today by launching a new trifold phone. You heard that right. As Apple is reportedly preparing to launch a foldable phone, Samsung comes up with a triple screen that unfolds into a tablet. Now, the stock has now almost doubled this year, and the race with Apple becomes even more interesting as the Cupertino giant gets a new head of AI and wins new market share with the iPhone 17. Now, here's a standout mover after strong earnings. Database software company MongoDB is rallying after beating expectations on both revenue and earnings. Revenue was up 19% year on year at $628.3 million. Its cloud product, Atlas again led growth, and management raised full-year guidance, signaling resilient enterprise demand at a time when many AI story names are facing challenges. It's becoming a bit of a picks and shovel stock for the AI trade. And here's another one. Marvell Technologies, the US chipmaker, is on the move after reports that it's in advanced talks to acquire Celestial AI, a photonics-based chip interconnect startup. The potential multi-billion-dollar deal reported by The Information would strengthen Marvell in AI accelerators and networking, two of the fastest-growing corners of the semiconductor market. Traders are treating this as Marvell's attempt to keep pace in the AI hardware arms race. One more player in this race to watch closely is Synopsys. It's riding Nvidia's momentum and chip design advances. Synopsys continues to trend higher as investors still love chip design and automation stories. The stock is also benefiting from ongoing optimism around Nvidia's next-gen architectures, which require the kind of custom design and verification Synopsys specializes in. Now, before we go, two more trending stories to watch. Costco joins the big tariff lawsuit against the US government. It's a wave of retailers seeking refunds if the courts strike down Donald Trump's emergency import levies. So that court ruling could have hundreds of millions at stake for companies heavily exposed to imported goods. Finally, Beyond Meat, where we're seeing new volatile moves. The ticker BYND continues to capture the imagination of retail traders after its sharp rebound last week, sparked by debt restructuring developments that traders interpreted as the company finally making progress on a turnaround. Expect to keep seeing big swings for Beyond Meat and other meme stocks. Now, if you want to know what's next for stocks, you need data about the economy. There's been a drought of economic data since the government shutdown, so some private indicators have become very important for traders. The ISM manufacturing PMI is one of them, and yesterday it came in lower than expected for November, showing a ninth consecutive month of contraction. Now, the committee chair of the ISM Business Survey, Susan Spence, broke down the data with my colleague Julie Hyman.
We've dropped another half point down to 48.2, missing the consensus of 48.8. So what we're seeing this month is really a pullback in new orders and employment. And I just like to remind folks, if you think about what we've been saying about a bubble of improvement that doesn't sustain, we're looking at, back in August, you had a pop in the new order index. That was followed by an improvement in production in September, backlog in October, and then the production index, of course, is up 3.2 this month. So you'd normally get excited about it if you saw a trend and that front end of the pipeline being filled with new orders month after month, but it is not happening. It is moving like a wave through the supply chain, and that is indicative, along with our panelists' comments, of orders happening because maybe customer inventories are too low, but not sustaining. So we're seeing the same issue, the tariff uncertainty. Now we have a Supreme Court case that everybody is waiting on to see what happens there. My understanding is it could take months and months and into spring, maybe even next summer before we hear about that. So our panelists are telling us the customers continue to only let out orders as they have to versus long term. Some companies, there's an interesting transportation equipment quote in this month's report that talks about, permanent changes are coming. We're issuing new guidance to shareholders. We are reducing the staff. And then ironically, and the opposite intent of tariffs, looking at offshoring versus, making in the U.S. and exporting. So what we're seeing is folks saying, listen, the tariffs make everything more expensive, and, the offshoring is still the cheaper option. It's just eroding the margin. So it is not having the intent that I think folks hoped it would. And we also have to look at the GDP numbers. The GDP of manufacturing sectors, we are at a 58 in contraction, same as October. Strong contraction is 39. It was 41 last month. If you look back to August timeframe, we had a strong contraction number. That means manufacturing sectors below a 45. It was 4% of those sectors in August. It jumped to 28 in September. It jumped to 41 in October, and here we are in November. It's still at 39. So not good. Decisions to build are not happening in the U.S. Interest rate cuts seem to have made not a big difference at all here, because it is still overwhelmingly tariff uncertainty, and in some sectors and commodities, the increases in their cost of goods sold and fully landed costs are just, it's going to take a huge hit.
And Susan, there's obviously the uncertainty in the pricing volatility because of tariffs, but I also wonder how much of it is sentiment driven. In other words, if I'm a foreign company or foreign client trying to figure out whether to order from the U.S., maybe I just say, the heck with it. Like, I don't feel like dealing with this when this is going to be the case. I don't know if there's a way of sort of quantifying that, but certainly I imagine you're hearing about it.
Yeah, for sure. We look at overall sentiment, positive to negative comment. Every positive comment, there's 3.5 negative. Demand sentiment, demand being soft. For every positive, we have about 1.2. And then the force to hire manage ratio. For everyone that's hiring, there's 3.5 people not. I think you're right. And I said last month, and maybe even the month before, the longer this goes on, the more my feeling is the more likely it is that these consumers outside of the U.S. are going to say, you know what, it's not going to clear up anytime soon. We can't live with this uncertainty. And it gives them more time to develop other sources other than the U.S. And I know our panelists are worried about that. So they're doing what they can, whether they take it out of margin, whether they reduce staff. There's only so many places you can go to buy goods and raw materials. So it is not good for this business. If it were, we would not be seeing this strong contraction happen, and to the big industries as well.
Okay, some breaking news now, and Signet Jewelers has just released its Q3 results. Now, on the face of it, we might expect to see shares rising. Adjusted earnings per share of 63 cents easily beat forecasts of 29 cents for the third quarter, and even sales of $1.39 billion beat the street call. But it's what the firm expects in Q4 that may be weighing on shares in the pre-market, down over 3.5% there, as you can see. It now sees sales and income in Q4 below where Wall Street had been expecting. Now, the CEO of Signet Jewelers will be appearing later on Yahoo Finance, so keep an eye on for that. It's interesting to note also that shares were already falling in the pre-market ahead of those earnings as well. Now, don't forget, after today's closing bell, we'll hear from the likes of CrowdStrike, Marvel, and American Eagle. Now, CrowdStrike and American Eagle shares are higher in the pre-market. As you can see, American Eagle up 1.4%, and CrowdStrike also higher in the pre-market too. All right, let's go to our check on the markets before we go. Let's start with a refresh on Bitcoin and a little bit of a fight back after yesterday's pretty dismal performance. Remember, it had its worst day since March, as I said earlier, but up over 1.5% already today. Gold, however, though, is falling. Following a rise in government bond yields. The rise in US Treasury yields dented the appeal of holding gold, given it's a non-yielding asset, don't forget. All right, let's move on to Asia stocks now. And Asian stocks rose in the main, recovering from yesterday's sell-off. Now look at South Korea, up really sharply there because South Korean autos were on the rise after US Commerce Secretary Howard Lutnick confirmed that lower US auto tariffs of 15% would retrospectively come into effect on November 1st. So the likes of Hyundai doing really well today as well, up over 4%. But overall, pretty positive in Asia. And in Europe, stocks are eking out gains in early trade too. It was a pretty shaky start to the trading day initially in the region, but it has got better. The risk-off mood seems to be easing in Europe. All right, let's check on Wall Street now. And US stock futures, they're also edging higher this morning, eyeing a slightly cautious comeback perhaps after a pretty fragile start to December trading that saw a sell-off yesterday on Wall Street. Okay, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. I'm Ramzan Karmali. Go own the morning.